All right, today we are diving deep into a real veteran of the Kuala Lumpur property scene, Tiffani Kiara. Now, if you know Mont Kiara, you know this name. But for investors, it's a bit of a puzzle. On one hand, it's famous for pulling in some serious rental income, but on the other, its value has barely budged in years. So let's figure out what's really going on here. And that really gets us to the core question, doesn't it? Is Tiffani Kiara a dependable cash cow that's just going to keep generating income for you? Or is it a value trap? Something that looks really good on paper, but ends up being a major disappointment. We're going to break down all the numbers, the lifestyle, everything to get to the truth. To really wrap your head around Tiffani Kiara as an investment, you have to think about it in these terms. This is not some speculative, high-growth gamble. No way. This is a workhorse, and we're about to see exactly what that means. Let's kick things off with the big, shiny positive. The estimated rental yield here, especially for the smaller units, is a super healthy 5.5%. That's the engine driving this whole investment. It's strong, it's consistent income, that's what makes it a workhorse. But here's the other side of that coin. A pretty weak annual capital growth of just over 0.5%. Wow. That's barely keeping up with inflation, if at all. So while that rental income is rolling in every month, the actual value of your asset is, well, it's basically flat. And this right here is the central puzzle of Tiffani Kiara. So this perfectly lays out the principle. Tiffani Kiara is a classic workhorse. You buy it for that reliable monthly paycheck, not because you're hoping to sell it for a massive profit later on. A racehorse, on the other hand, is the complete opposite. You're betting big on appreciation, and the rental income might be way less predictable. Just understanding this difference is absolutely key to making the right call here. Okay, so if that rental yield is the star of the show, let's really dig into why it's so strong. What makes this specific property such a rental powerhouse when the market is so crowded? Well, the answer really comes down to the tenant profile. See, this isn't just any old rental pool. It's a high net worth expat community. We're talking about established Korean and Japanese families, the ones whose kids go to the fancy international schools nearby. And you've also got professionals on corporate leases. This is a stable, premium group that really values convenience and, yep, they are willing to pay for it. So why are they all flocking here? It's like a perfect storm of amazing location factors. First and foremost, you are practically next door to top-tier international schools. Then you add in the fact that you can actually walk to the shops and restaurants at Solaris. Plus, you have the security of a freehold title and a proven history with corporate leasing giants like Ascot. Put it all together, and you've got a recipe for constant, reliable demand. And really, this quote from the analysis just nails it. The entire financial argument for owning a unit here is built on this one single foundation: its magnetic pull for those expat families and professionals. If you lose that, the whole workhorse model just falls apart. Right? It all sounds pretty great so far. A reliable income stream from a premium tenant base. So you've got to be asking yourself, okay, what's the catch? Because with capital growth that low, there has to be one. And trust me, it's a big one. And this brings us to the property's single greatest weakness, its Achilles heel, and that is gridlock. The entire issue boils down to connectivity, or more accurately, the complete and frustrating lack of it. And what you've got here is this fascinating paradox. On paper, the connectivity looks fantastic, right? You've got direct on-ramps to all the major highways, but in reality, that access leads you straight into some of the worst traffic in the city. And that problem is made so much worse by the total absence of any walkable public transit. No MRT, no LRT, nothing. So let's be crystal clear about this. Living here without a car is simply not an option. It's just not viable. This complete car dependency is a massive lifestyle drawback, and it's a huge filter for potential tenants and future buyers who actually value public transportation. So you see how that traffic problem directly hits the quality of life, which then feeds right into the other major issue we talked about at the start, that stagnant capital growth. Let's take a closer look at why the value of this property just refuses to climb. A little bit of history really tells the story here. Tiffani Kiara was finished back in 2009, right in the middle of this massive building boom that just flooded Mont Kiara with high-rise condos. And now, all these years later, it's facing a second wave of competition from newer, more modern, and frankly, more luxurious projects. And this is the direct result. The property is basically caught in a value trap.
Any buyer who's looking for true modern luxury has plenty of newer, shinier options to pick from. This intense competition creates a price ceiling, and it's stopping Tiffani Kiara's value from ever really breaking out. Okay, so we've seen the good, that strong rent, and we've seen the bad, the low growth and the terrible traffic. So how does an investor take all of this and come to a clear verdict? Should you buy in or should you walk away?
Now, this is really interesting because what this chart shows us is that Tiffani Kiara isn't one market, it's actually two. Just look at the price per square foot for the small units, a whopping 825 ringgit. Now compare that to the big family units, down at just 502. It's clear the smaller, high-yield rental units are in a completely different and much healthier market than the larger ones. So let's sum up the case for buying. First, you get that high, proven rental yield. You get a highly desired freehold title in a prime neighborhood, and you get unbeatable walkability to shops and international schools, which is exactly what keeps our target tenants happy. And now, the case against it. Absolutely zero public transit, chronic traffic that really hurts your quality of life, an aging building that's only going to need more and more maintenance, and of course that basically non-existent capital growth. And look, these are not small risks. They are fundamental to what this property is. So here it is, the final verdict. Tiffani Kiara can be a great investment, but, and this is a big but, only for a very specific type of person. First, you have to care more about stable income than you do about capital gains. Second, your whole strategy has to be focused on that expat rental market. Third, you absolutely must target the smaller, high-yield units. And finally, you have to be completely okay with the traffic and the lack of transit. If you can't tick all four of these boxes, this property is not for you. And that really is the bottom line. It brings us right back to where we started with that analogy. There's no right or wrong answer here. There's only what's right for your strategy. So the real question you need to ask yourself is this: what does your portfolio need right now? A steady, reliable workhorse or a high-stakes racehorse?